Go to tradeseasonals.com, click on Start Scanning. This is the seasonal scanner dashboard on Trade Seasonals that comes up. On the right side, what you're looking at is what we call Seasonal Viewer. Seasonal Viewer shows you performance of a stock or any security during a particular date range. What do I mean by that? Let's say I want to know how Apple performs if you bought it this date, which is May 12th, and you sold it after, just pick a day, let's say 60 days. After 60 calendar days, that would be July 11th. So this is the gains that you would have. Let me shut this off and tell you what that is later. This is the gains that you would have every single year starting 2012 if you bought it on May 12th and you held it for 60 calendar days until July 11th. In 2012, you would have made 8.28%. 2013, you would have lost 6%, and so on. Every single year of these, you can see what the gains for Apple stock is during this date range. This is what Seasonal Viewer does. You can make changes to this. Let's say we want to know what would happen 100 days after May 12th, which corresponds to August 20th. As you can see, the gains change. I mean, the entire trading strategy is buy it on May 12th, sell it on August 20th. I mean, this is just your gains during date ranges. So, and this number is your number of calendar days, and this is how many years do I want to look at. You can pick anything from 5 all the way to available data 37. So look at 10 years a lot because that's usually a very relevant number for seasonality, but that's up to you. This is a research tool, so whatever you want to check, you can just select that. So now, as you can see, if you held it for 100 days after May 12th, the gains are better. It would have lost in 2015, but it would have been a winner all other years. Now, how much money would you have made if you did this every single year the last 10 years? I'm going to click this right arrow to the right, or you can also drag it. As you can see over here, this is profitable 90% of the time, 9 out of 10 years, 1 losing year. Cumulatively, it has made 318% if you did it every year last 10 years. You would have made an average profit of 16.34%, standard deviation of 16.04%. That means your fluctuation in profit from year to year is 16.04%. So this is what Seasonal Viewer does. It shows you the performance of a stock or a security during a date range. That's that. I can make changes to this. You can always play with this and try to look at other things. What if we held it for 150 days? Changes a little bit, but cumulative return didn't change that much. But now, how do we actually find really good date ranges? Well, one way is for you to go and click every single possible date and every single possible number of days hold and take a look and see how it performs. Or we have ran a very large algorithm that goes and finds all of these possibilities and it lists it for you on the left. So let's see, within the Dow 30 stocks, so we're only looking at 30 stocks, United Healthcare comes at the top. Take a look at that. If you bought United Healthcare and held it for 60 calendar days until July 11th, you would have been profitable 10 years every single year, average of 6.6%, with a small standard deviation of 2.78%, so year-to-year profits are stable. This is a really good trade. That's the top pick of our scanner. We can click the second one, Visa. Visa is also a very good trade, but the algorithm found that you should hold it for 71 days for the highest probability. It was profitable 10 out of 10 years, and so on. Now, these are the opportunities based on the number of years we selected over here for the date we selected here, which is May 12th. And over here, the probability years, we said, show us stocks that are at least 90% profitable. So it goes to 90 plus. We can also go and say we're okay with 8 out of 10 years too, and you're going to get a larger list. We can click on any of these and take a look at how it performed over time. But what if we think it's better to look at 14-year seasonals? With 14-year seasonals, it has only found 13 out of 14 years, so there's no 100%, but 12, 13, 12, and 11. 13 out of 14 years is 93% profitable. Let's take a look. United Healthcare. As you can see, it lost in 2008, but it's been profitable every year since if you held it for 279 calendar days until February 15. You would have made an average of 18.41% with a standard deviation, which is fluctuations from year to year, of 15.35%. You can also go on and say, we're okay with lower probability. 11 out of 14 years, that's 79 years. 79%, sorry. And you're going to get a larger group of stocks. As you can see, you can have up to 3 losing years, and our algorithm picks it up. You can also look at your cumulative return. How much would you have made if you did this every single year? In this case is 435%. Then you can come over here and you can make modifications to this. What if I want to look at all the data on seasonal viewer? This is not a part of an algorithm. This is a part of seasonal viewer. It just shows you the data for 37 years or 35 years. Or you can go and say, I want to see 240 days. If I held it for 240 days, which goes to January 7th. You can play with this and see how it actually performs during different times of the year. Now, there's also this one, pull down. It says month and quarter. This is just a shortcut that puts the start date and number of days for you. For example, we can see how did this stock perform in the month of January. So Apple, last 35 years, if you bought it first day of January, or actually that would be the first trading day after January 1st, and you held it until the end of January, which is 31 days, it would have been profitable 21 times and a loser 14 times. You would have made a cumulative return of 64% over 31 years. Not the greatest trade, but you can take a look at how a stock performs in different time of the year. I usually look at 10 years. Oh. There. So how did it perform last 10 years, the Apple. As you can see, basically you would have not made any money. Januaries are not the greatest months for Apple over the last 10 years. How about February? Better. You would have made 54% cumulatively. March, only 1.61%, mostly because of a huge drop in 2020. April, little okay, 36%. May. What if we take a look at it by quarters? First quarter. As you can see, every time I select this, it updates the dates and the number of days. So it's just a shortcut. You could always just go and type it over here yourself. But you can see first quarter, you would have made 56.73% from Apple. Second quarter is better. Third quarter, 187%. Fourth quarter, quarters don't seem to be great, but what about seasons? How did Apple do in spring in the last 10 years? You would have made 94% if you bought Apple first day of spring and sold it last day of spring. Summer, you would have made more money. So Apple is actually more bullish in the summer than it is in the spring. Fall, not so great. It has a couple of big drops last 10 years and not very profitable. How about winters? Cumulative return last 10 years for winters is not good for Apple. So I hope you understand what seasonal viewer means now. What are these two things? MFE and MAE. MFE is the maximum favorable excursion. I got these acronyms through automated trading world. They use these, but all that means is how much did this profit margin go in your direction before the end of the trade. So if I click this, you're going to see this. Well, because this is a short trade. I didn't explain this to you. Let me do it with this. Okay, so now we're looking for a long trade. Seasonal viewer colors this thing green or red. If it finds more green than red over the years you're taking a look at, it says this is good, better bullish trade. If it finds more red or more shorts than greens, it says this is a better bearish trade. So right now this is a bullish trade. When you click on MFE, you're going to see this light green part that goes on the top of the dark green. So dark green is your profit if you bought it during this date range, if you held the stock during this date range and sold it. And light green that you see here is how high did that actually go. So let's take a look at this one. I just clicked 2017, so you're going to see the stock chart for 2017 between May 12th and February 15th. Do you see how it went up to this level, 233, and then it closed lower? The light green shows you if by some luck you knew exactly when to sell it at the high of this trade, how much could you have made? That's the light green on the top of the dark green. The second one, maximum adverse excursion, means that how much did it go against you before it came back up? So as you can see, that light red or pink shows you how much below the opening price did it go? So let's take a look at this one. Do you see here? It went up, then it dropped, so it was a loser here. The lowest level it went against you is this pink, light red part. So this is just to give you an idea how each date range is performing. I usually take a look at it without them initially, but then you can always add them. Now, one other thing you can do is, well, actually there's so many things you can do. Let's take a look for high-flying stocks. I look at high-flying stocks with a very short seasonals. I go up to like 5 years. As you can see, when I go to 5 years, I get a much more profitable, larger list. I'm going to click the first one, Walmart. We are, by the way, looking at only Dow 30 stocks. So these are opportunities within 30 stocks. I'm taking a look at Walmart. If you bought Walmart today and you held it for 84 calendar days until August 4th, you would have made average of 6% with a very small standard deviation. So this actually is a profitable trade that also is very stable from year to year. So, but average profit over those 84 days are not huge. How do we find high-flying ones? You go down here and you take a look at percentage filter. Let's go all the way to the bottom and say filter everything that is at least 20%. So if it didn't go up 20%, filter it out. We only want to see stocks that have gone up 20%. In this case, it is Salesforce. Salesforce, if you bought it on May 12th and held it until January 12th, in the last 5 years, you would have made minimum of 20%. Take a look. It also turns on the MFE, so you can see using the MFE, it has gone minimum of 20%. In 2020, it actually went 60%, and in 2021, it was 35 plus 12, so almost 50% here. So this is actually a fairly good one, but it's over a longer range of time. You can click any of these and take a look at the stock chart. But this is only within Dow 30 group. What if we go to a much larger stock group? Let's take a look at Russell 1000 stocks. So here's our Russell 1000 group. And we go down and, we want to go for high flying. So I'm looking for 5 years. Then I'm going down to see, we have 35-year filter available. I click that. I take a look. And the first one that comes up is Lululemon. If you bought Lululemon today and you held it for 214 calendar days, that stock went up an average of 35% before it closed a little bit lower, but very high flying during this time. Also Horizon Pharma, 35%, Trex, and Enphase. These are high flyings that you can actually use in case they go. Now, these days, market's been dropping sharply. So how do we use seasonality during when markets are tanking? Well, there are two ways. Number one is markets don't go down forever. They reach a point and they turn around and go up. You can see them go up. But when they go up, what stocks do you want to get into? you can just go over here. The stocks that have gone up this time of the year are the best candidates to go up again when markets turn around. So that's one way of using it during a bear market. And the second thing is, we also know exactly which stocks are actually a good short. Let's take a look. We are going to shut off our filter. So we are looking for, let's go look for 8 years. I usually look for 8 years for shorts. Click on direction. Click it a couple of times and you see the shorts on the list. Look at that. Pilgrim Pride between today and June 7th, it has gone down every year last 8 years. How is it going to do this year? Oh, chances are good it's going to go down again. While the market's going down, this is going to go down. If the market was going up, this used to still go down this time of the year. So the chances are good it's going to continue. Another one, US Steel. Again, a bear opportunity. I'm going to drag this and actually take a look at what kind of profits we're taking a look at. 4.74%, 4.2. That is a good one. ExxonMobil. Now, ExxonMobil has gone down last 8 years. During this time of the year, if you shorted Exxon today and held your short for 81 days, you would have made average of 4.4%. However, I don't recommend Exxon at this moment because Exxon is very, very volatile these days because price of gas is volatile. If price of gas stabilizes, then Exxon would again be a good candidate, or you can make your own decision, but these are things that I think about. Here's a long-term short, Kirby Corporation, from today, holding it for 155 days corresponding to October 14th. It's gone down for 8 years. Average of 11%. This is another good short. Viatris has gone an average of 12% over 142 days. Another good short. Citrix, over only a 7-day period, it has gone down every year last 8 years. And as you can see, in some cases, it closed near zero, but the light red shows you that it dropped sharply and then came back up somewhat. And the rest are bullish. But if you go to shorter time frames, you get a larger bearish group. So over 5 years, you can see that there's many, many more shorts, which are definitely candidates to take a look at if you want to trade shorts because of the bear market. But typically, I don't recommend shorts unless you're sure the market is going down. But then again, this is a research tool. There's no specific way of trading this. You use this in order to create a trading strategy around the data that you're taking a look at. Let's take a look at other things. How about S&P 500 stocks? We can take a look at which one of the S&P 500 stocks is at the top of the list. I'm going to click the first one. Republic Services has gone up 10 out of 10 years between today and July 25th. How much? Slide to the left. Average of 5.77%. Shorter communication has gone up average of 15.28%, and so on. How about other things besides stocks? We want to take a look at. One of the things I look at quite a bit are indices. If you look at indices, most indices have gone up this time of the year, but right now we're not interested in that. I'm going to click it a couple of times and take a look at what else can we find. How about the VIX? The volatility index has been dropping this time of the year previously. So if we weren't within a external forces that are pushing the overall market down sharply, VIX would go down. So if this is going to repeat itself, the VIX should really be going down in the next 71 days. And so VIX is the index and VX is the actual futures. Another short one, US 30-year Treasury goes down this time of the year, last 10 years except 2013. 5-year Treasury, another down, it's been going down, so on. What else can we take a look at? Futures and commodities. The very first one, lean hogs commodity, is a short this time of the year. It goes down. It's been going down last 10 years. How about last 42 years? Take a look at that. Lean hogs go down this time of the year. And that's not the case all the time. Lean hogs in April goes up. Take a look at this. What if I say, let's take a look at lean hogs and hold it for 30 days. Look at that. Lean hogs was going up sharply in April, only over a 30-day period, and then started dropping. Yeah, we're going to talk a lot about that when that time comes again, because this one is definitely a good one to follow. How about Forex? Liquid Forex? Forex doesn't seem to be very good seasonally over long periods of time. So let's take a look at shorter periods. What if we look at Forex? Liquid Forex is only 18 Forex pairs. Over those 18, the best one is US dollar. I believe this is Swiss franc. Maybe not. Average profit of 2.12% with a small standard deviation. It's a short. And don't forget, Forex is highly leveraged, so a drop of 2% is a lot. So cumulative return of 11%, you can probably, I don't know exactly what the leverage is, but it's maybe 100 times, 100x. You could make a lot of money, but I am not a Forex trader. This is pure data, but after looking at this, maybe I should be. Japanese yen, bullish over last 5 years with a gain of 3.63% and a low standard deviation. What if we go after all the Forex pairs? This includes the low volume ones. Top one. I don't even know what this is. Yeah, it looks, this kind of patterns show you low volume. I don't like trading anything low volume. This one shows higher volume. The patterns are more natural. This is Pakistani rupee, Japanese yen. This pair has been bearish between May 12th and September 7th in the last 10 years. Very high average profit of 5.64% on a Forex pair. That's very high. So this is another possible good one. Take a look at other ones, so on. Let's take a look at ETFs. Look at the first ETF, S&P 500 Healthcare Sector Spider. 10 out of 10 years between today and July 19th, you have made an average of 5.77%, low standard deviation, another possible good trade. So next thing is, how do we look at performance? How do these things perform? We know that the markets turn bear market. Seasonality works better when markets are not doing the outliers, which is going sharply up or sharply down due to forces that are not common. So if market truly is changing direction from bull to bear, it may be good to wait for these. So let's actually see how would things have performed if we started how did our trades do in April? So some of them should not do well. So let's take a look at NASDAQ group. April 1st opportunities. I will click them and take a look at Pepsi. Pepsi was making an average of 8% over the last 10 years. And here is the 2022. We are still within an active trade. Pepsi went up all the way to 4% and then dropped. It's still profitable by 0.5%. So it's actually holding up somewhat, but we are still inside an active trade. Active trade means the end hasn't been reached. The end is July 19th. So this is going to show active until July 19th. How about Mondelez? Mondelez also is doing well. If you went on it on April 1st, you would have made over 3%. As you can see, there's a light green up there, means it went up and came back down. Here's the stock chart. But it was a much more solid trade previous to that. Let's see if we find something that's losing. There it is. So this one is Charter Communication. If you bought Charter on April 1st and the trade is still active, so it could go back up. But as you can see, it dropped. And that's what the red shows you. This trade is losing 16% from April 1st. But it's active, it has a chance of going back up. Astrazeneca, also, it's dropped by 8%. But it was a winner for up to 7%. You could have actually taken profit on this one. It's possible. The light green is showing you that. It says it went up 7%, which probably is, actually it is this, before it went down. Costco, also a loser, but inside the active trade. So chances are that these may not work this year, but if you would to wait for the markets to turn around. These are the ones you want to trade in because these are the strongest over the years, which means chances are really good for them to be very strong again in a market turnaround. Microsoft even dropped. Microsoft dropped 15.79% since April 1st. ADP, Comcast, 15%. Amazon dropped 35% since April 1st. But who knows? Amazon should come back when the market turns around. Dexcom dropped 40%. How much did these stocks drop the other years before they came back? Let's click on MAE. As you can see here, this 40% drop shows you there's something different from the other 10 years. It's dropped much sharper than all the other years. So I would think that chances are good that Dexcom may have been turned into a bear market. How did it do in all the data that we have? It has reached this low in 2011 to about, see, minus 30, minus 9.4. So almost minus 40, same as now. So and in 2006, it went to minus 41. If it goes below minus 41, this phenomena has not occurred before during this date range in the 16 years of data that we have. So you can make those selections and take a look, or you can press the right triangle and then look at any of these and look at your data. Look at this, 800% for Adobe if you bought it today and sold it December 13th in the last 10 years. But you would have lost money this year, minus 17%. You can also always take a look at the filters and see the filters show you if there's a stock at, for example, one of these percentages. If there's no stock, it won't show. So there's no 20 or no 30%, but there's a 15%. Cintas. Turn these up. Cintas made an average of 32% over the last 10 years each year, with 1,247% cumulatively. However, this year, so far, it's a loser, but we are inside an active trade. Things still have a chance to turn around. I can switch to 10 years. You get a bigger group. I can also change the probability years to get a better group. So 8 out of 10 years. Now you have a bigger list. You can even take a look at opportunities that are 6 out of 10 years profitable. Which is 75%, which is the lowest probability we actually calculate. So we don't like going below 75%. And in not all cases we calculate 75%, but in this case we do. But it's a lot of fun. I think whenever I look at this, is that I just turn the light on inside of a dark room. Now you get an idea about your stocks or securities or anything. Also take a look at government bonds. They're not very exciting. But let me show you another interesting phenomenon. German government bond. Let's take a look at one of them. Do you see how this is upside down? See if I can find a better one. Oh no, that's Hong Kong. There. Here's German government. Do you see how this looks upside down? The reason for that is, and I'd heard about this, I never noticed until looking at this, is that German government bonds have negative yield. Germans pay the government in order to hold their money instead of government paying them like they do here. So this shows you yields, the upside down yields. I can't even imagine how to trade such thing, but I'm sure there are some Germans that understand it well. Take a look at 2022. This thing has dropped sharply. 6-month bond. I am not exactly sure how politics have anything to do with this, but maybe the war in Ukraine has something to do with this. We're going to have other groups coming up throughout the years, but this is what we have available right now. We're going to have cryptocurrencies being added soon, and then many other groups, and then foreign stocks, and so on. All right, I think you know enough to start playing. See you in another video.